Good morning, everyone, or good afternoon, depending on where you are, and welcome to today's webinar. I'm David Tasker from Chapter 1 Advisors, and I'll be hosting today's RaaS Plus Ask the Analyst webinar. Thank you for joining us. It's great to see such strong interest. Today's format is pretty straightforward. We'll hear from three of RaaS's senior analysts. Each will present a short update on a company they currently cover or are watching. We will then open the session for live Q&A where attendees can engage directly with the analysts. A quick reminder, today's session is general advice only and attendees will receive 1 CPD point for participating. This webinar is currently open to the public. However, future sessions will become exclusive to RaaS Plus subscribers. So this is a good opportunity to experience the format and content for yourself. The research discussed today has been released to RaaS Plus subscribers, so I urge you to have a look at the platform and look at the extreme value being presented by the RaaS Plus service. We have a strong lineup today. Graeme Carson covering Acusensus, ASX code ACE. Issam Eid covering Saunders International, ASX code SND. John Burgess covering xReality Group, ASX code XRG. We'll move straight through the presentations and then return for Q&A, so get your questions ready. You can submit them using the Q&A button at the bottom of your screen. First up is Graeme Carson covering Acusensus. Graeme will walk through the strength of the Australian business as validation, offshore growth, particularly in the US and UK, the emergence of new verticals such as road worker safety. Graeme, over to you.
Thank you, David, and thanks for hosting today. As David explained, I'll be talking about Acusensus today, ASX code ASE. I think a very strong Australian growth company. So just to move through to the agenda, what I'll be discussing is a brief company overview, which for those who don't know the company should give a bit of an explanation on why we think that this is a proven business domestically and can, we think, gain significant traction offshore and expand into much larger markets with a similar offering that are proven here. They're also expanding their offering into a new vertical in road worker safety, and I'll touch on that. And then I'll give a brief summary of my thoughts on the business and the industry in which it operates and the fact that there's some heavy M&A traction in this industry historically. So to the Australian business, this is where the company has really proven itself. Now, it was only founded in 2018. It is founder-led. Alex Yannick, the CEO, is still a shareholder to the tune of about 10%. And has built a pretty impressive business over that period of time. It was listed in January 23, and what it offers is basically a suite of AI-enabled road safety solutions. So think about speed cameras, distracted driving for mobile phone detection, seatbelt detection. That's basically at the core of the offering, although it is broadening from here. Currently, it operates in Australia, New Zealand, the UK, and the US. And of course, the contracts themselves are long dated, often 5 years plus 2 1-year options, and they are with governments, so pretty secure and stable payers, obviously. The operating performance of the business since listing has been impressive. Revenue CAGR from around its first contract in FY19, I think. So revenue from that period to now is sitting at around about 90 or 100%. But even if we look at it on a more realistic basis from FY22, when some of the core contracts were established, it's still delivering over 30% growth from that period to what guidance is, which is around about 85 million in revenue at the midpoint. It's important to realise that that's all organic growth. They haven't acquired any businesses, so they've started this from scratch and built something pretty substantial in a relatively short period of time. At the EBITDA line, the operating earnings line, you can see that in the bottom chart there. Midpoint of guidance for FY26 is around 8 million. Now, that could be much, much higher and will be much higher when the business is more established. But at the moment, they are investing heavily in growth, in new product development, and entering into larger offshore markets. So they're carrying the cost of that. But we'll talk about what the operating business looks like in a region when it's more mature on the next slide, which is a focus on the Australian business. It is very much the validation from our perspective. This is a technology business and a business model that's proven in Australia. I think it's important to note that in the past, some of the comparables in the Australian market in this space have made money from a camera sale and then from volume of tickets that are issued or fines that are issued. That is not the model that Acusensus takes. It's a sort of a hardware as a service model with licensing and other fees. The volume of fines or offences do not impact earnings at all. They don't clip a ticket on any of that, which I think is a real sort of validation as to why they're going about this and they're making genuine change. So the first contract was a New South Wales contract in FY19. They're now in 5 states and territories in Australia. And again, just note that revenue is contracted with government agencies, mostly state, obviously, in this instance. The contracts are multifaceted contracts, so yet in many cases they might start with speed and then overlay distracted driving or seatbelt detection. In fact, I think last year around 80% of their contracts were either extended or expanded. So, there's still some growth left in Australia. Now, the revenue at the moment is about 55 million. Well, it was FY25 revenue of 55 million. That'll grow, obviously, this year. GP margins are pretty impressive, sort of in the mid-40s. That will move around depending on contract structure and bundling, but we believe it will stay above 40% generally over the lifetime value of these contracts. Now, if you remember back to the previous slide, we talked about EBITDA guidance from management at around about 8 million for the year. If we remove the Australian business, which is definitely the most mature business, given it does 55 million of the 58 million last year, or 59 million last year, its adjusted EBITDA on a standalone basis would actually be 19.5 million. So it is carrying costs for expansion into new verticals and obviously into new regions. But once these are established, they're very high margin, highly profitable, government dated long-term contracts. So it's worth saying that Australia is a validation and they can extend that offshore. Even in Australia, they're still growing. They won or extended contracts in WA, ACT and Queensland in the first half of FY26. Victoria is one state they haven't secured. It's not up for grabs, but it is coming. It is coming to a tender process in the next 12 months or so, we would imagine. And that chart on the right shows, I think, the quality of Acusensus offering versus some of its competitors, which is why it's really now dominating the Australian market as a clear number one. If you look at the mobile phone offences in New South Wales, which is the Acusensus contract, they had over 160,000 in FY25, and in Victoria, they had around just over 20,000. So we do think that there's a technology advantage here. So now that it's proven, and I think this is where the really exciting part is, we're talking about offshore traction as the company moves into new regions. I'll point you to the revenue contribution chart on the right, which just compares first half 26 to first half 25. The large grey bar, which dominates revenue, is obviously the Australian business. You can see the international business is growing, but as of the current half, you're going to see that really, really accelerate. And a lot of the growth that management is guiding towards for this year, in the mid 80 million range, is going to come from offshore markets. So firstly, late 24, they won a $92 million contract, New Zealand dollars in New Zealand. Obviously, that's a 5-year government contract that is now fully mobilised, and you'll start to see that come through. The US, which is a huge market, it's taken a bit of a while to get real traction here because we know how disparate and strange structures some of these state-based models are in the US. But Acusensus have actually now landed 6 state-level projects for real time. When we say real time, we mean there's like a police officer or someone involved. think radar gun for us in the past, but it's just real time. But what they've done now is they've won their first automated work zone, and it's the automated ones that are dominating the Australian landscape, and the US model is starting to move towards that. That was in Connecticut. That's a $34 million contract. And, that is going to be, that's currently being deployed. And by the end of April, will be fully deployed. And that's a real landmark deal. And we think that's a leading indicator for what can come in the States. They have expanded their sales team over there and doing a great job of it. UK, probably a bit of a slow burn, but they're already in 19 regions that have trialed with Acusensus and have had the first enforcement program activated. So we think that there's an opportunity there as well. But the US is the one that we are excited about in the short term. There are also a company, in the next slide I'll show, and I'll just touch on this because it's early days, but there is a new vertical that they're entering, which is road worker safety. The business is called Foresight, and it's a predictive safety solution. It was only launched commercially in October last year, so it hasn't really contributed a great deal to any printed numbers yet. But the idea is it protects the people who work beside traffic. So their first big trial was with a company called Fulton Hogan, which most people will know, and they have now signed service partnerships and service agreements with a number of tier one construction companies and traffic management companies. Again, a hardware as a service model. Some of the workers, for example, at roadside wear a device, and then there's a lot of other hardware and software associated with it for safety reasons. So it's an early stage business, but we think a very significant opportunity. If you think about the model being each road worker, the cost for that is a few dollars per worker, and this is thousands. These teams of thousands of people, so it could be pretty significant if they get traction there. I don't think a lot of it is in the numbers that are out there, the forecast, but we do think it offers upside. So finally, just as a bit of a summary, we think this is a real growth opportunity, multifaceted, proven in Australia, accelerating internationally, very well funded. They raised money last year and they've got debt funding as well. We think all that movement to raise new capital and to get new Citibank-led debt funding is a leading indicator to their confidence of the success in the US market. So we think there'll be news flow coming in the next few months. They're in a net cash position. The EV is not demanding when you can look at the opportunity and you look at the valuation in the Australian business when it matures. So look through these short-term numbers as evidenced by the Australian business, and I think you have a pretty substantial business offshore that becomes pretty cash generative. Strong M&A history in this sector from both private equity and trade sales. So you can see the numbers on the right. They've got some contract secured there going forward, so the pipeline's strong as well. So yeah, we just think it's a good growth opportunity. And as a disclosure, I do hold shares. Back to you, David.
Thanks, Graeme. As I mentioned in the beginning, Graeme will be back a little bit later to answer any questions specifically in relation to his presentation. I'd now like to welcome Issam Eid, covering Saunders International. Issam will cover the company's transformation into a diversified contractor, its growing pipeline and acquisition strategy, and the potential pathway to a market re-rating. Issam, over to you.
Thank you, David. Thank you everyone for joining us this morning. As David said, I'll be running through Saunders International and why we believe there's an opportunity in terms of this stock re-rating. If we go to the next slide, please, David. Yep. So just in terms of the agenda, I'll quickly run through who Saunders are, what they do. In terms of our investment thesis, what the strategic metamorphosis looks like and what it encompasses. And more importantly, this is not something that's, we believe is a high risk strategy. There is an established playbook through other listed peers such as SRG and Southern Cross, and we'll run through those case studies. We'll look at the peer valuation of its listed peers. We'll run through our valuation. We'll run through the key risks that we see to the business in terms of meeting that or achieving that re-rating, and then provide a quick investment summary, as well as just touch on the financial profile in terms of its earnings going forward. If we can go to the next slide. So in terms of the summary, Saunders has become a multidisciplinary contractor serving 4 key sectors: defence and government, water, energy, and resources and industrials. Its capability set spans across bulk storage for both fuel and water, structural, mechanical and piping, industrial automation, electrical, civil and water infrastructure, as well as maintenance services. It has a national footprint with over 580 employees, with some small operations offshore. It has a market cap of about 120 million, and as David highlighted earlier, the ticker is SND. Next slide, please. So in terms of our investment thesis, what the strategic metamorphosis we're talking about, we're seeing the company evolve from a specialist contractor into a national multidisciplinary delivery partner. So you can see when it first listed in 2007, in terms of its capabilities, it was a specialist in design, construction, and maintenance of bulk storage tanks. Then in 2017, it acquired Civil Build, which then enabled it to expand into specialist bridge design and construction. And then in 2021 and 2023, it added automation to its capability, both industrial process automation as well as control systems. And in 2023, it also added a piping solutions acquisition, which was the fabrication, installation, and maintenance of steel pipes. And then in 2025, by far its largest acquisition, it acquired Aqua Metro, and that allowed it to provide maintenance and construction services into the water utility space. If we go to the next slide, we can see how the company has diversified by sector. Again, when it listed, it was in 2007, it was solely exposed to the energy sector. By those acquisitions and by expanding its capability, it is now in 2026 exposed to energy, defense, resource and industrials, and water. And we can see how that transformation has actually, sorry, on the next slide, David, impacted the business going forward. You can see in 2020 that its order book, or actually its order book was only 70 million, and that has grown eightfold to 550 million today. And in terms of the pipeline, that has expanded sevenfold from 671 million to almost $5 billion, as we can see on the chart on the right-hand side. And then the key thing also is that you can see by the pie chart on the far right, energy is now roughly a quarter of the opportunity set, whereas back in 2020, it was almost 2/3 or 3/4 of the opportunity set for the business. So we've seen that evidence in the pudding, so to speak, as the company has evolved into diversified across sectors and also expanded its capability offering. And we're seeing that through the larger work in hand plus the larger pipeline of work. If we go through to the next slide, in terms of the path to re-rating that we believe the company can achieve, this strategy is not new. The playbook has been established by various listed peers already, such as SRG, Southern Cross Electrical, Service Stream, and Duratec. And these companies have been successful in transforming themselves from either single disciplinary or single industry focused entities into either multi-industry and or multidisciplinary companies. So we've seen those companies actually evolve over the last 5 or 6 years in terms of their transformation and become or get re-rated for that diversification. So if we start with the first case study on the next slide, we can have a quick look at SRG. SRG started its journey in 2018 in terms of diversifying the business when it merged with another listed entity called GCS Construction, and it has continued to diversify its business and geographic reach. And we can see that underneath on that chart there, where in 2022 it acquired WBHO, which is an infrastructure services business in WA out of receivership. And then in 2023, it added ALS Asset Care, which allows it to provide asset integrity and reliability services as part of its maintenance offering. So what they do is pre-check to make sure that if there's any potential structural issues with the building or the jetty, for example. In 2024, it acquired the Owner Proprietary Limited to actually expand into the water utility space and energy sector. And then its most recent acquisition was Total AMS, which allowed it to expand into marine infrastructure services, so things like maintaining jetties or building jetties and other marine infrastructure associated with it. So If we go to the next slide, we can see what impact that has had on the business. So back in 2020, it had $700 million worth of work in hand. That has increased sixfold to 4.2 billion, the most recent result, and the pipeline has more than doubled. And what we've seen in terms of the market reaction to that, it has rewarded the company, and we've seen its EV/EBITDA multiple more than double from 3.77 times to more than 9.5 times. If we go through to the next slide, we can see a similar thing happening with Southern Cross Electrical. Southern Cross Electrical was first floated in 2007. It was purely exposed to iron ore electrical work before moving into energy over the following decade. As Gorgon came on stream, we saw some major LNG projects in WA. It then proceeded to diversify away from resources into infrastructure and commercial, as well as expanding its capability outside of WA and becoming more of a national operational business. So in 2020, it acquired Trivantage Group, which provides electrical maintenance services to the supermarkets, predominantly Aldi, Woolworths, and Coles. It then acquired MDE Group in 2024, which allowed it to enter the data center space and providing construction services and maintenance services there. And then more recently, it acquired Forcefire Holdings, which moved it into fire detection and suppression, which is, these are all complementary capabilities that can enable them to bid on one commercial site and basically deliver a full range of suite of services. We can see what that has done to the business on the next slide, David. We can see that the order book has more than doubled, or virtually almost doubled, from 440 million in June 2020 to over 700 million more recently at the first half result. Importantly, you can see that on the slide on the left-hand side, resources, which is the red vector, that was representing almost a quarter of the business back in June 2020. And now you can see on the right-hand side, that blue shaded part of the pipeline, part of the order book, is now less than 7%, or thereabouts, approximately 7% of the order book. So we've seen a successful diversification of the business away from its core founding capability. And the market has again rewarded that with the EV/EBITDA multiple more than doubling from 3.2 times to over 8 times. If we go forward to the next slide, the other key thing, it isn't just about having strategic intent. You actually have to deliver and the earnings growth, so the market will reward it. And we can see that both SRG on the left-hand side of the slide and Southern Cross on the right-hand side of the slide have both delivered earnings growth over that period. And you need to deliver and actually execute well in order to get that re-rating. So just simply saying we're going to diversify for the sake of diversifying. The acquisitions need to make strategic sense, and also we need to see the financial benefit of those acquisitions, which these companies have delivered. If we go to the next slide, we can see what the peer group is trading on. So you can see there's those 4 listed peers being SRG, Southern Cross, ServiceStream, Duratec, trade on significantly higher multiples than Saunders at the moment. They're virtually double. If you can see the average there, it's about 17 times FY27 earnings in terms of PE, and EV 8 times. And we look at FY27 earnings because that's a clean year in terms of earnings for Saunders, where they've gone through some contract issues in 2025 and the first half of FY26, and we'll speak about those further in the financial profile later on. But you can see the size of the prize, that the Saunders, its multiple and potentially share price could double if they can deliver on the strategy that they're undertaking. If we go to the next slide, you can see our valuation there and summary there. We've used an earnings capitalization approach, and we're using FY27 earnings because that's, as I said earlier, these are a clean set of numbers there, that we expect to be a clean set of numbers there. We're using a multiple of 6 times, which is a discount to the market and also a discount to its listed peers. And based on those numbers there and the net cash position, we expect our valuation is $1.12. If the company can re-rate to the similar multiple of its peer group, there's potentially another 30% upside to our valuation. If we go to the next slide, what are the key risks? Well, as I said earlier, it's all about execution. You need to deliver on your strategy, and you need to show how that translates into the financials. So in terms of the key point, they need to hit their guidance for FY26. They've actually put guidance out there of revenue between 315 to 345 million, and then normalized EBITDA margin between 3.5% to 4.5%. And they also need to show sustainable earnings growth going forward. We also need to see them convert that pipeline into the order book. There's the pipeline, as we saw, is about $5 billion worth of work out there. They currently have tendered on over $700 million worth of work, which they expect to see results come out within the next 12 months. So the big risk here is obviously failing to win, and also potentially contract awards being delayed. Other key risk is obviously Aqua Metro has been their largest acquisition to date. Any integration issues they have there, it's in terms of the company's the response to that. They said the first half that Aqua has integrated pretty well into the business and is fully integrated. So hopefully that risk has been mitigated. And then the other key risk, obviously you're a contractor, you need to ensure that when you tender, that you tender the right margins and you take into account the appropriate risk profile so that you can earn the margin on that contract going forward. Otherwise, if you fail to do that, then you end up with poor profitability. If we go to the next slide, in terms of our investment summary, we believe the foundations are in place for the company to follow a similar path of re-rating to its listed peers. We see earnings recovering from a weaker FY25 and first half FY26. So we believe that's the trough of earnings there, and we expect earnings to grow quite consistently going forward. And that's supported by the order book as well as the pipeline of potential work. We've seen an upgrade in terms of the revenue quality coming through. Aqua Metro brings a significant amount of recurring revenues to the business. And that was about approximately 35% of revenues in the first half across the group. And that helps reduce the volatility of revenues and earnings going forward. They offer a diversified platform across growing end markets. So defense, we've seen the federal government step up and invest significantly across defense sites right across Australia, both in the north and west and in the east and south. So there's been significant expenditure there as the government is increasing its spend towards 2% of GDP. Water is driven by population growth. And the other key factor at the moment is with the explosion data centers being built, they require a significant amount of water to cool and maintain the servers within the data centers. So there's going to be a significant step up in demand for water, and we have to see how that will impact, obviously, our water bills going forward. Energy is quite topical at the moment, given that what's happening in Iran with the conflict there and what's happened to oil prices. In Australia, we currently have enough capacity for fuel to last only 30 days. The IEA recommended number of days is 90 days. So we only have a third of what we should be holding in terms of strategic fuel reserves. So maybe that will wake up the government that they have to invest strategically into our fuel capacity going forward. And we could see a significant increase in spending in that sector going forward. And then obviously resources and industrials, it's a very large space for them. They've only got a small foothold in it. So there's potential for them to win more work there. The balance sheet's pretty resilient with net cash reported at the first half of 17 million. We expect it to be cash flow positive the second half. The re-rating pathway, again, it's about demonstrating and executing on the margin normalization, converting the pipeline, and showing sustainable growth going forward. And its platform is pretty similar to what the other diversified listed peers that we saw in terms of capability and sectors they're operating in. Management continuity, the new CEO has been appointed. He was previously the COO, so he's been there, I think, since 2017. So he obviously understands the business pretty well. And a factor which may or may not be an issue is obviously this business is reasonably AI resilient until, I guess, robots are invented to actually perform services and maintenance work and construction work. They're pretty, at the moment, they're relatively resilient from that point of view. And we actually expect them to benefit in terms of AI being efficiencies of how they manage the business internally. So if we go to the final slide, we can have a look at the financial profile there. Earnings prior to FY25, you can see they're consistently growing, both revenues and earnings. Really, FY25 was a hiccup and the first half of FY26, and that was caused by delayed contract awards and inclement weather on a bridge building contract in New South Wales. Those projects have been fully provided for in FY26. We don't expect them to be an issue going forward. We believe the company can get back to its historical margins, but on a much larger revenue base. So we sort of see earnings growing from here, and we're going to see upside in terms of the quantum of earnings it can earn going forward. With that, David, I'll hand it back to you.
Thanks, Issam. And as I mentioned, he will be back a little later to answer any questions you may have. Finally, we have John Burgess covering xReality Group. John will focus on the growth of the Operator XR platform, traction with defence and law enforcement customers, and how the business may be reshaped through the potential sale of its entertainment division. John, over to you.
Thanks, David. And we'll just move to the agenda. So hopefully a short and sharp presentation. I'll give you a divisional overview. There's two divisions. The growing division, Operator XR, or I think they call it Enterprise, what the opportunity is and how they're progressing, and a very simple analysis relative to some software peers, small cap software peers, just to put them in that context, and how the sale of their entertainment business could reshape the business. So if we go to the next slide. So there's two divisions. So XRG listed under a different, what I think was iFly in 2013, and they were basically an indoor skydiving business, and they added freak entertainment through the journey. But those two businesses are now pretty much either under review or being exited as this new Operator XR enterprise business takes off. The entertainment business in first half 26 was 47% of revenue. So it's still operating and still substantial. It's sort of like 15, 16 million revenue a year. But the focus is very much Operator XR. So we believe, or the company certainly says, that they're in the final months of coming to a conclusion on this review and / potential sale of the business. And as I say, it's got a book value of about 15 million, give or take. Operator XR is their training hardware and software platform for law enforcement and defence. It's fully mobile, it's secure in the cloud, and it's fully customizable by the user for various scenarios, various training scenarios they might undertake, whether it's de-escalation or sieges or whatever. They can customize this platform for the training that they want to give their officers. It's important to note that this business really only made its first sale, I think, to WA Police in 2023. So it's really only been around in its current shape for about 2.5 years. And in that time, they're also just about to launch, or just have launched, a new counter-drone training platform as well. So if we go to the next slide. So the opportunity, and again, I'm quoting the company's numbers here, but they say there's about 18,000 law enforcement agencies in the US alone. And they're probably in, I'd be guessing, but they're probably in about 60 of those now, perhaps 60 out of 18,000, and 800,000 sworn officers across the US that could use this platform. Of course, there are competitors, but it's a very big market. In Europe, they're not really a big player in Europe at the moment. They're certainly doing sort of events to showcase the platform and getting together a distribution network. And they exhibited recently in Germany in February. And it's a bit of a crass sort of snapshot from their website, but certainly they were very excited by the feedback they got from this presentation. And in APAC, obviously they're in Australia, and they've made their first commercial sale in Japan just recently. So the US has been the focus and still will be, but certainly Europe and APAC are not forgotten. If we go to the next slide. So where are we today? So as I said, I think the first customer was signed, WA Police, in 2023. Since then, a range of clients have been contracted, including the US Department of Defense, Australian Federal Police, Texas Department of Public Safety. So these are sort of big, reference customers that are well into using this platform to train their people. As I say, in Europe, they're certainly conscious developing distribution teams and showcasing the product. Maybe a couple of years behind the US. They closed the first half of 26 with 89 customers. And if you think, that was up from 67 in June and 50 in the PCP. So they're sort of adding 1 to 1.5 customers per week, from a starting base in 2023. ARR, annualized recurring revenue, is ended the half at 6.2 million. So that's up 72% on the prior corresponding period. And we'll get to the peers on the next slide or two, but that's about as strong a stronger growth as you'll see in the sector. So David's put up here the peer comparisons. We've tried to use peers sub 200 million market cap as a more relevant base to compare a company who's 36 million currently. But you see down the bottom there, XRG delivered 72% growth in ARR. The average growth for the peers that we've selected was 13%. And the highest growth was Kinetico at 42, and there's a few players sort of suffering a bit of churn. And you'll see the EV to ARR ratio. I guess for that growth, XRG is trading on a higher multiple than most of those peers, and that sort of makes sense given their growth rate. And you'll also see that the higher the growth, typically the higher the EV ARR ratio, which again also makes sense. So this is important when we come to the next slide and have a look at what the potential sale of their entertainment business does to the business optics. So we've given you the first half 26 result there. So a couple of things to note. The legacy business, sorry, I got those revenues. Yes, the revenue is closer to 8 million for the year. The legacy business still grew 2% over the half, and the Operator XR enterprise business grew over 100% in revenue. They were EBITDA positive, and we adjust for grant income, so we don't include grant income in the numbers. And even excluding grant income, they were EBITDA positive. Costs are growing, but not as fast as sales, so you're getting that operating leverage. But what you'll also see in the results is fairly high depreciation numbers, and also a fairly large interest expense. And the depreciation is predominantly the entertainment business, so it's got the big silos that you do the skydiving in, and so they're being depreciated, over a period. And should they sell that business, that depreciation will drop out of the numbers. And it'll change the numbers below the EBITDA line. And similarly, should they sell that business, you would expect, somewhere around book, then the interest expense would become interest income, because debt's not particularly high. And net debt's about 2 million for this business. They got debt of about 4 to 5 million. But that would disappear clearly post any sale. So the other thing to note is that, so if we assume a sale of around 15 million, and it could be, I don't know what it's going to be, but if we assumed a sale of about $15 million, then the EV to ARR would fall from the 4.9 that I mentioned on the previous slide to about 3.8. So obviously, the ARR doesn't change because the entertainment business doesn't have ARR, but the EV changes with the net cash. So the numbers would look, the P&L numbers would look a lot better, and the EV ARR would drop a full point, and then relative to their growth rate, looks even more attractive to the guys growing in the sort of mid-20s. So that's the real opportunity and the catalyst coming up, I think, in the next 3 months as we move to the next slide, which just talks about the risks. And I think the risks really this business centre around that entertainment business to becoming a distraction if there is no sale. And I guess in defence, in law enforcement, there is governments do like to award contracts to companies in their own jurisdictions. So there's some risk that we become a little, rather than free trade, it becomes a little becomes more back to supporting locals. But then, from my understanding, they are winning contracts against local suppliers as we speak. Liquidity, obviously, for a small cap of about 36 million is an issue just from a share price trading point of view. And obviously, peer multiples, we've seen a lot of contraction in software stocks, and so that obviously impacts the potential multiples you apply to this business if they stay low for a period. And key man risk, I guess. I mean, I think most of the management have skin in the game here. They've got a very good mix of ex-military and and sort of software people. But key man risk is always an issue with small businesses like this. So that's a very quick snapshot of XRG.
Thanks, John, and thanks to your fellow presenters who will now come back to assist us and be part of the Q&A session. Just to remind everyone, if you do have any questions, submit them using the Q&A box on your screen and I'll direct them to the relevant analyst. We'll aim to get through as many questions as we can in the time we have available. Graeme, I'll jump straight to you. Couple of questions have come through. So you've highlighted strong traction offshore, particularly in the US and UK. What do you see as the key trigger for material revenue inflection internationally?
Look, I think it's having these milestone contracts, such as a new one in Connecticut. I think that leads the way for other states, certainly in that nearby region, and even more broadly to follow, especially as the legislation and regulatory environment eases up across the states. Acusensus have actively gone out and got approvals for their solutions in the regulatory environment. So I think now that they are fully funded, because you have to roll out these contracts with some CapEx spend early on. So they're fully funded with both equity raised cash and that new debt facility, and they're increasing their sales team over there. So I think the next 12 months are going to prove to be that period where they get genuine traction and uplift and start to see some operating leverage out of the States.
Now, I am going to try and group all the questions I have for each analyst so that we're not playing proverbial analyst ping pong here. So, Graeme, another one for you. Given the reliance on long-dated government contracts, how should investors think about revenue visibility and contract renewal risk?
Yeah, good question. Look, they are the contracts in, let's use the Australian market, I think, as a reference point, because that's a proven business. Most contracts are 5 years and then plus 1 and 1 optionality. Some are 3 years plus 1 and 1. I think I mentioned in the presentation that over the last 18 months, or I think around 80% of their contracts have been extended or expanded. So basically the takeaway is, once you've got these contracts, if you're delivering really good results, which Acusensus are proving to do, they're very sticky and they become very entrenched. Now, in New South Wales, for example, what that government has done is say, okay, we're going to give it to 2 or 3 providers. I think Acusensus has got about 40% of the total addressable market in New South Wales. There is potentially an opportunity now that they have got such a good track record that increases through a new tender and they actually expand that contract to be the sole supplier or certainly have a bigger chunk. So it's just their track record, long-dated contracts and delivery that positions them well.
And the Foresight roadworker safety solution is still at an early stage. How significant could this vertical become relative to the core business?
Look, it could be anything. The way I would love to see it play out is that, they deliver these solutions that almost become the safety benchmark for construction companies and civil companies, whereby if some of the market leaders, let's use Fulton Hogan as an example, do implement this and there's a proven safety benefit, as there has been with all their other solutions, It could become the norm, and they're certainly market leaders in this. I don't know of anyone else who's doing it. It's going to be, again, proven up in the Australian business, but it's a huge global market. If you think about all the road workers out there, and Acusensus is getting paid on a per wearable, per worker per day, look, it could be big. It's not in the numbers, as I don't think the US is largely in the numbers either in the traditional business. So I think the optionality here on the growth side is pretty material.
And you mentioned valuation is not demanding. What do you believe the market is currently underappreciating?
I think the market is looking at the group earnings position, especially at the EBITDA line, and extrapolating that on the number it is at the moment, whereas there are a lot of costs embedded in that are basically buying future growth on long dated, very cash generative, high margin contracts. And I think the example I used of the Australian business on a standalone basis, when you reallocate costs, is generating off that 55 million, around 19 million EBITDA, where the group as a whole is only generating 8 million EBITDA. So I think it's once this scales and has traction internationally, and these contracts mature and the business matures, that you're going to get a very profitable business whereby an EV of sort of 200 million is going to be a long way in the rear vision mirror.
Thanks, Graeme. Now, Issam, I'll jump over to you. We've grouped all the questions that have come through so far. So I'll throw them at you now. So you described Saunders as undergoing a strategic metamorphosis. What stage of that journey are we currently in?
They've put all the building blocks in place. So from my perspective, it's set up to actually now try and drive the earnings higher, so that they have multi-sector exposures and they're all growing sectors. So as we saw from the pipeline went from less than $1 billion in 2020 to $5 billion over that period. So look, it's not to say they won't acquire other things along the way. They may do that, but right now the foundations are in place for them to grow, and they don't have to acquire anything else in order to be able to convert that pipeline into higher revenues and higher earnings going forward.
And you reference peers such as SRG and SXE re-rating over time. What key milestones does Saunders need to achieve to follow a similar path?
As I guess it's similar to the answer to the first part of the question, is that they actually need to deliver. So we need to see execution. We need to see the management team, have discipline in terms of the contracting, ensure that the margins are protected. They need to deliver on the earnings growth. They need to convert the pipeline into higher work in hand, and that will drive higher revenues and higher earnings going forward. So everything's in place. It's all about the management team executing, winning their fair share of work, and delivering the margins and controlling the risks on those margins going forward.
And with a pipeline of approximately $5 billion, how confident are you in conversion to revenue, firstly, and what are the key risks?
Look, the key risk is obviously winning, and then you always have competitors in that space. The thing that gives me confidence is that the work they're bidding on is in their core competency. So, for example, Defence is spending a significant amount upgrading its energy fuel depots around the country and building more fuel storage. They've been a key player in that space. There's only 3 players in the space nationally. One is still in receipt or closing down, which is I think US McDermott's is the US operator. The only other operator of significant size is EVZ, which is a listed entity. So there's only 2 players really in the country, and so there's only 2 people you can go to in order to build those tanks. So that gives me confidence in terms of the energy space as well, because again, we saw that with the conflict in the Middle East at the moment, energy or being energy sufficient and in terms of a national strategy is key and important. And we only have 30 days worth of fuel supply or capacity storage within Australia. And the IEA has recommended every country should have at least 90 days worth of storage. So there is a significant scope if the government is actually serious about this. We actually have to expand our energy infrastructure quite substantially over the next 5 to 10 years to ensure that any such disruption in global or energy markets or oil markets or fuel markets will not impact Australia. And we're already hearing stories of shortages of fuel in the country. There's no diesel. And I think more recently someone was saying that contract in WA is actually put off its fly in, fly out employees because there's no fuel to operate the equipment. So it is a significant issue, and this war has highlighted how important energy self-sufficiency is. So we need to have I'm sure the government's looking at what our options are going forward. So we're pretty confident in that space. Aqua Metro, which I acquired, which is in the water space, that is a pretty significant business, profitable business in its own right. They're trying to expand that out of Victoria into New South Wales and Queensland. They've recently been appointed to the panel for Sydney Water. So we're seeing traction in different parts of the business, and there's core parts of their capability which will stand them in good stead going forward as spending increases in those sectors.
And finally, how achievable is a return to sustainable EBITDA margins, and what are the key drivers?
Okay. I think on the last slide, we saw the financial profile. Up to 2025, the company had consistently grown its revenues. Its margins were reasonably consistent between 8 to 9%. So we can see what the company can earn when it doesn't have problem issues. And FY25 was impacted by the fact that they ramped up their workforce in order to win contracts. Those contracts were delayed, notably on the defence side. And also we had inclement weather and flooding in New South Wales, which actually caused them to rebuild a bridge that collapsed twice. So those things are hopefully one-off in nature. You'll always have potential contract delays, but I think now, given the size of the order book, given the diversity of the business, no one contract should significantly impact the business in terms of, it's the timing and when it comes through. So as long as we can see them getting traction and conversion on the order book, then I think they're in a pretty good position to be able to deliver consistent margins around that 8 to 9% mark.
Thanks, Issam. We may come back to you a little later, but I'm going to throw to John now and put him under the hot seat in relation to xReality Group. Couple of pretty well-crafted questions here, and hopefully I pronounced them right. What do you think the catalyst path and profitability over the next 6 to 12 months in particular? And I'm quoting the question, I'm thinking along the lines of A, another Texas DPS style contract, B, a counter UAS contract in the US or Europe, or C, a follow-up DoD contract to the project that ends in May?
Well, I guess all would be good. But I think the nearest term catalyst is the potential sale of the entertainment business, clarity of the sell price, and then the cash that comes with that to really put your foot down on the growth strategy. But I think probably the biggest one would be probably a counter drone contract. So the new product I think we feel like the XR operator XR has got validation, but the drone one is only very new. So a new contract there would be a big tick. So that plus the sale of entertainment are probably the two big ones.
Question just on valuation methodology. Because XRG is a mix of hardware and software, lumpy, government in areas, still has a legacy entertainment division, how do you think about the right valuation methodology that you would be using?
Yeah, so just to be clear, we don't officially cover the stock and have a valuation. I mean, obviously, I've got my own views, but in terms of methodology, I would be looking at the entertainment business as a book value. It's a bit hard from the accounts because they've got the enterprise business or operator XR, they've got entertainment, and they've got a corporate cost. And it's hard to know within corporate costs what really relates to, corporate or what really relates to maybe some of entertainment. So an earnings multiple is a bit hard, and obviously operator XR is not it's break even, maybe just starting to get that inflection. So the methodology would be a book value for the entertainment business and probably an EV to ARR as a good sense check for the operator XR. And then what sort of multiple and what year, that's another sort of thing. So they've only been in the market for 2.5 years with this product. So I don't think taking first half 26 ARR is probably fair. So I think you'd probably want to take a 28 forecast and then put a multiple, put a multiple of that you're comfortable with relative to sort of peers. So to me, 4 to 5 times is probably 4 to 5 times FY28 is probably a fair multiple. That's how I
And
go about it.
as you touched on, Operator XR is clearly the growth engine. How scalable is that platform globally?
Look, it appears very scalable. It's in the cloud. It's a hardware piece with obviously software, and yeah, it's eminently scalable. And obviously it's got there's just one of 31 DPSs in the US, Department of Public Safeties. It really isn't in Europe yet. And with everything going on with NATO and does NATO exist or not? I mean, there's a whole bunch of training that still needs to be done, and yeah, so I mean, it's eminently scalable.
Now, I do have a final question for each of you. We're almost at time. And I'll let you go right to left depending on how you look on the screen. But if you had to nominate one key KPI for investors to track for each company, what would it be? Graeme, maybe I'll start with you, then Issam, then John.
It would be basically ARR, or annualized revenue.
Okay. For me, the key KPI for the next 6 months anyway is them delivering on their earnings guidance, which they've put out there and made quite explicit.
I'm going to say 3. I'm going to say 2. I'm going to say sale of entertainment, because I'd like to, I don't want that being a distraction. So just sell it, and then obviously I think ARR / success with the counter drone product.
On that note, thanks, gents. And thank you, everyone, for joining us today. I would like to say a big thank you on behalf of everyone watching to Graeme, Issam, and John for their insights. So thanks, gents.
Thank you.
Thanks, David.
And as mentioned, future sessions will become exclusive to RaaS Plus subscribers. So we encourage you to explore the platform. Have a good look at the research. It's quality research, it's sector specific, and it is something that will help you make buying, selling, and trading decisions. So if you enjoyed today's session, check it out. We thank you for your time, and we look forward to seeing you